Hey there, my name's Curtis. This is my channel, Empire Building. This is one of the most frequent questions I get from people who would like to begin investing for themselves in the stock market. Is now a good time to start investing in the stock market, or should I wait for the price to drop and then buy? In my opinion, the correct answer is to do both.
What does that mean?
Confused? Nobody knows what is going to happen next in the stock market.
Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways.
And anyone who says they do is either trying to get you to sign up for their online course or is flat out lying to you. The reality is that if these people could know, even with a relative certainty, when the market was going to go up and down, then that person would literally be worth trillions of dollars. So, what is the answer? Well, remember, the question had two parts. Should I invest in the stock market now? The correct answer to this is, and always is, yes. The second part was, should I wait for the price to drop further and then buy? The correct answer to this is also always yes. You see, when buying stocks, you don't have to just buy them once. You can do it over and over and over again for the rest of your life. The important part to remember is never invest more than you can afford to do without. Notice that I said never invest more than you can afford to do without. I did not say never invest more than you can afford to lose.
You never invest more than you can afford to lose.
I can't stand it when people say that about the stock market. I don't care how much money you have. No one enters into an investment with the idea that they are okay with losing everything to that investment. Is it possible? Look, there are plenty of ways to lose all your money in the stock market, but you would have to break a lot of very important rules for that to happen. Stick with me, and I'll cover more of those rules as time goes on. But this video is about one simple yet very powerful investment strategy. DCA, or dollar cost averaging. I would be so bold as to say that armed with this strategy and this strategy alone, anybody without any further skill or knowledge could outperform the vast majority of hedge fund managers out there. But don't take my word for it. Let's look at the data. Let's face it, what people are saying when they ask this question is that they want to maximize their return on their investment. I mean, why buy now if the price is only going to be lower later and you get to buy at a discounted price? To illustrate this example, let's pick the scariest and most volatile investment out there.
Bitcoin. Bitcoin is
Bitcoin.
That's right, I said it, Bitcoin. Let's imagine you had the worst luck there was, and you finally chose to enter the Bitcoin market at the very peak of the bubble at $20,000. So, to implement this strategy, you are going to invest $100 every week. Now, let's imagine your bad luck didn't end there. Imagine that your timing was also so bad that you bought at the highest price it traded at in every week that you made your purchase. By today, you would have invested $10,900, and you would be sitting on a gain of 15%. with an average cost basis of $7,156.20. So you can see that cost averaging has an incredible ability to allow you to benefit when prices drop. The key is to stay disciplined and, most importantly, not sell as soon as the prices begin to recover. Also, like I mentioned, this is hardly a realistic example. No one could ever be that unlucky. The whole point of dollar cost averaging is to take the guesswork out of the equation. So you will always put the same amount of money at the same time every week. In this case, let's just pick the close of every week. Using this data, we find the more realistic result would actually be a 23% return on investment with an average cost basis of $6,647.73. It is important to note that this will do you no good if you're implementing this strategy on investments that have no future. No amount of cost averaging will help you if you had invested in Enron or Bear Stearns or Lehman Brothers. Now, some of you may be saying, but you just said to invest in Bitcoin and it's going to zero, so...
Bitcoin is worthless artificial gold.
I would short it if there was an easy way to do it.
They're gambling.
Hey, I'm not going to argue with you. So let's look at another example. For most investors, new and old, the best thing that they could select as an investment vehicle would be an ETF that tracks the general market. Now, I realize that some of you might be saying,
What's that?
as defined by Investopedia, an exchange-traded fund, ETF, is a type of security that involves a collection of securities, such as stocks, that often tracks an underlying index, although they can invest in any number of industry sectors or use various strategies. ETFs are in many ways similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like ordinary stocks. In this case, I will use just the Vanguard 500 index, which tracks the S&P 500. The S&P 500, or Standard & Poor's 500 index, is a market capitalization weighted index of the 500 largest U.S. publicly traded companies. The index is widely regarded as the best gauge of large cap U.S. equities. Okay, now that we got that out of the way, let's see the results. Just for fun, let's compare the S&P 500 to Bitcoin since the Bitcoin bubble popped 2 years ago. Starting to invest $100 per week would lead to a total return today of 15%. I have to admit, I was a little surprised myself when I saw those numbers. So I thought, let's dig a little deeper and compare some of my other favorite investments to illustrate this a little further. And I charted all these results to show how your return on your investment changes over time with this approach. I added Tesla, which is still on a tear, and this was my big lesson from 2019. Only pick stocks that have huge long-term potential, and when things finally turn around, do not sell on the first sign of profit. These should all be long-term holding positions, also ones that you can continue to contribute to. Tesla would now have a return of 81%, while Ethereum, which is currently my favorite cryptocurrency, is still sitting on a loss of minus 35%. Or another way to look at it is buying a lump sum today would actually outperform the cost averaging strategy. We can cover that more in another future video. The most important thing is that you take control of your future and start today. It takes discipline and it takes time. This will not change your life quickly, but it will change your life. The most important thing is that you change your mindset, because once you realize that you have the power to create a better future for yourself, there's no limit to how far that can take you. If you're still listening, then thank you. And if you enjoyed this video, please hit that like button at the bottom of the video. And if you want to see more content from me, then hit that subscribe button and keep an eye out for more videos. I'm still learning how to create better and better content for you, so it takes time, but I hope to put on at least one video per week and try to make these topics more interesting for you, my viewers. Thanks for listening. Now, let's get back to empire building.